Imagine, you were in college in the early 1990s. For lunch, you and your friends usually go out to socialize while also grabbing yourself something to eat. One day you discuss where to have a coffee and one of your friends mentions the latest cafe in town. So you decide to go there and realize that many of your fellow students are going to the same cafe as well. The atmosphere here with the smell of the freshly brewed coffee and the relaxed vibe impresses you. You are fascinated by the concept and you want to get to know more about it. You find out that the small cafe is part of a chain that is expanding very quickly. And being a business-minded person, you start some hands-on research about the company. You visit several of the other stores and recognize that the quality remains as high as in the one near your campus. You look at the financial statements and despite the phenomenal growth of the company, its shares seem to be relatively cheap. So you decide to invest, let's say, $10,000 of your savings. Guess what? You bought the stock at a time around its IPO and have held it until today. You have made 100 times your money, which results in a sum of $1 million today. And this figure doesn't even include reinvested cash dividends. The company we are talking about is Starbucks. You didn't grab this opportunity? Don't worry, there are always other ones. The years go by and before you know it, you have 2 kids in primary school. Like their peers, they love nothing more than watching TV. Literally. Every day you are forced to prize them away from television. And every time you suggest playing outside, you notice that they watch the same series over and over again. Your kids really admire those cartoons and it goes even further. At the toy store, they are begging you to buy the latest playsets they have seen advertised from the TV series. And they are not interested in anything else. As a pleasing dad, you give them what they want, but still you notice that they want more. They just love those cartoons, and now you start to think. After doing some research, you identify the company behind the TV series and its merchandise. You immediately see the potential of the company's business model. It seems that they pump money out of the ground like an oil company. So you decide to invest $10,000 in the stock of Walt Disney. Today you sit on shares with a value of $100,000. If you didn't grab this opportunity, don't worry, there are always other ones. On the weekend, your wife drags you shopping and so you end up going to the high street with her. It comes even worse. Your wife goes straight to the busy store on the street. You enter the store and see immediately that everybody jumps at the chance to get the clothes they like. Your wife tells you that the store always has the latest clothing trends for affordable prices. Again, you do some research and find out that the company is listed on the stock exchange. After you do some further research, you decide to buy stocks in Inditex, the company which operates the brand Zara. By now, it turned into a small fortune as the stock went up 30-fold. Well, at this point you probably ask yourself with good reason why we name these examples. It is not to show you what incredible investments you could have done. In hindsight, everything seems to be so obvious. The point here is rather to illustrate that you can actually put Peter Lynch's investment strategy in action and spot tomorrow's big winners. The key here is to be present to your environment. You have to observe carefully any new developments at the workplace, the mall, the restaurants, or anywhere a promising new enterprise makes its debut. But be aware guys, Peter Lynch doesn't advise you to buy stocks in your favorite store just because you like the products, neither in a restaurant because you like the food. Liking a store, a product or a restaurant is a good reason to get interested in a company and put it on your research list, but it's not enough of a reason to own the stock. Never invest in any company if you haven't done your homework. Always analyze the company's earnings prospects, financial condition and competitive position. And don't forget to ensure that the product, which got you excited in the first place, adds enough to sales to have a meaningful impact on the company's overall performance. Peter starts his analysis with placing the potential investment into one of 6 general categories. They help you to look at the companies from the right perspective, as each of the 6 categories has certain characteristics you have to be aware of. The leading characteristic within the first 3 categories is the growth of earnings. First, the slow growers. These are usually made up of large and aging companies that are expected to grow slightly faster than the gross national product. You can think of McDonald's as an example. Stalwarts are companies such as Coca-Cola, Procter & Gamble, Johnson & Johnson and Berkshire Hathaway. These multi-billion-dollar giants are not exactly agile climbers, but still they are faster than slow growers. When you are invested in Stalwarts, you can expect more or less 6 to 10% annual growth in earnings. Lynch advises everyone to have some Stalwarts in the portfolio as they offer pretty good protection during recessions and hard times. The fast growers are small, aggressive new enterprises that grow at 20 to 25% a year. Although there's higher risk if you choose wisely, this is the land of the 10 to 40 baggers and even 200 baggers. These are Lynch's favorite investments. In hindsight, examples include Zara and Disney. They don't have to be in a growth industry, but what they need is a winning repeatable formula like Starbucks had when it started out. Something that has proven itself in more than one location and still has room to grow. The second group is made up of special situations. Cyclicals are companies whose sales and profits rise and fall regularly in an almost predictable fashion. In general, they follow the overall pattern of the economy. Examples would be in the automotive and steel industry. Timing is everything in cyclicals. You have to be able to detect the early signs that the business is falling off or picking up. And therefore, it is important that you have an edge in the industry. Turnarounds are companies that are depressed and often close to or even in bankruptcy. You can find great opportunities among this group as they can make up lost ground very quickly. They are a great way to diversify your portfolio as their ups and downs do not follow the direction of the general market. An asset play is any company that is sitting on something valuable that you know about but the Wall Street crowd has overlooked. The asset play is where the local edge can be used to the greatest advantage, because often the undervalued assets are made up of real estate. To sum it up, Peter Lynch encourages everyone to follow his or her own investment strategy. He believes that the amateur investor has an advantage over the Wall Street crowd by being constantly aware of any changes in the daily environment. Well guys, this was the first part in our series about Peter Lynch's investment strategy from the book One Up on Wall Street. If you liked this video and you want to discover more financial concepts that will increase your investment success, subscribe to our YouTube channel.